Hey everyone, thanks for joining. We'll get started in just a minute. All right, we'll go ahead and get started. 12:31. Thanks everyone for joining today. We have a really great panel, a couple panels for everyone to listen into about AI and financial services and kind of the importance of that, the innovation that's occurring there, but also things for us as congressional staff to be thinking about in the policy area. So on behalf of the AI caucus, I'm Elizabeth from Congressman Gonzalez's office. So I'm the one who's been annoying you with all the emails. But it is great to have you joining us today. And we're looking forward to two great panels. So with that, I won't waste any more time, but I'll kick it over to Joanne Barefoot, who is moderating our first panel.
Thank you, Elizabeth. It's wonderful to be with everyone today. Greetings and thank you for joining us. I'm Joanne Barefoot. I am CEO and co-founder of AIR, the Alliance for Innovative Regulation. We are a Washington-based nonprofit focused on helping financial regulation modernize through technology, especially to do better for financial inclusion. And I'm thrilled to be with you today on this important topic. AI has been around for 65 years officially, and in that time there have been a lot of predictions that it was going to change the world, and they haven't come true yet. And if we ask ourselves what's different today, and it's great to be talking with an audience that spends time on AI and thinks about it, what's different today is that now we have data that can make AI practical and useful. Data is being digitized at an explosive rate. And because we have the combination of ubiquitous digitized data and AI techniques, we can suddenly do things we could never do before. And it's clear that this is going to change the world through pretty much every sector, including financial services and financial regulation. And it also seems pretty clear that some of these changes are potentially problematic, terrifying even, but also that there's massive upside potential for doing better. As someone who's a former financial regulator myself, I was deputy controller of the currency and I worked on the Hill, also at the Senate Banking Committee. I've spent my career working on how to make financial regulation really work in its goals of system resilience and financial inclusion and consumer protection and financial crime. And our track record is mixed. We haven't fully achieved those goals. So maybe AI can help us do better if we get it right. So that's the topic of our first panel today. And I'm really thrilled to be able to introduce our panelists. And then I'll invite you to turn your cameras on. Our panelists are Andrew Burt, managing partner and co-founder of BNH.ai, and Melissa Coity, CEO of FinReg Lab, and Matt Van Buskirk, co-CEO of Hummingbird. And I want to begin by asking each of you to just say in a few words what your organization does. Keep it short because we've got a lot of ground to cover. And Melissa, let me start with you.
Sure. Hi, everybody. It's great to be with you. I'm the founder and CEO of FinReg Lab. Before standing up FinReg Lab, I was the Deputy Assistant Secretary for Consumer Policy in the U.S. Treasury Department. FinReg Lab, though, for those of you who are not familiar with us, is a DC-based nonprofit, non-advocacy research organization. And we are specifically honing in on undertaking both empirical research to understand the consumer, the market, and the policy implications of particular data uses or technology uses, or the combination of data and technology in financial services. And with that empirical information, we then engage policymakers, regulators, and the broader financial ecosystem to evaluate what does that mean for existing law and regulation, especially in light of potential inclusion and consumer protection goals. So it's a pleasure to be with you today. We have a pretty extensive multi-year research project underway looking at core questions around transparency and explainability in using machine learning algorithms in credit underwriting. So we'll talk more about that as we get into the conversation.
Thank you, Melissa. Matt.
Thank you very much. I am honored to be able to speak to this group today. So Hummingbird is a RegTech company where you can basically think of us as an investigations platform, primarily focused in the financial crime space, where we help organizations perform their investigative work. Large companies use our tools to complete investigations and file suspicious activity reports. And then in the context of AI here, we're very focused on supporting the development of interoperable and open source data standards so that the financial industry broadly can learn from each other rather than operate it in silos.
Thank you. And Andrew.
Yes, so I am co-founder and managing partner of B&H.ai. We're a boutique law firm based in Washington, D.C., jointly made up of lawyers and data scientists. And our entire focus is on managing the risks of AI and analytics. And it's really wonderful to be here today.
And we're happy to say that we know each other, and I'm going to encourage the panelists to mix it up a little bit, but also I'll apologize in advance if I move us on at some points because we do have a limited amount of time. But with that, I want to jump into talking about what might be the upside use cases for AI in financial services and financial regulation, recognizing that financial services as a sector is more sensitive than many others where we see a great deal of use of AI. I think a lot of people think a lot about the downside risk, but less about the upside. So let's go to that. And Matt, let me start with you. What do you see as the potential that AI techniques could massively improve if you do think that this massively improve how we deal with financial crime, and any other upside you want to talk about?
I'll put it into context. I started my career as a regulator with the Office of Thrift Supervision. And after a couple of jumps, I ended up in my prior role with a company called Circle, which is currently one of the larger stablecoin developers in the world. By the time they were one of the first crypto exchanges, and we were faced with the challenge of needing to build a foundation that could help us deal with fighting financial crimes in a completely novel area. I rapidly found that AI was the only solution. And one of the observations that we've had is basically the only companies in the world that are deploying true AI in the anti-financial crime space are the global scale fintechs. One of the reasons why this is the case is that AI requires a lot of well-labeled and structured training data to work. And in most financial institutions, you have a lot of data silos, particularly in the compliance space. Most of your training data is locked up in Excel spreadsheets and SharePoint all over the place, and none of it's available in a structured form. And I think it was actually 5 or 6 years ago when Melissa asked me to come in her prior role to brief some of her colleagues on what we've been seeing at our experience at Circle. And one of the discoveries that I had there was that if you're using techniques to fight financial crime that are focused on sort of the core data that we're all required to gather, the know your customer type data elements, you're more likely for a fraudster to pass those checks than you are for a real person to, because our identities are so thoroughly compromised that they can use completely authentic data, and they're using scripts to enter that information into the company's platform so they don't make typos where I might reverse my date of birth or something along those lines. So if we're in a world where fraudsters are more likely to pass KYC than a real person, you need to look at a much wider set of information. And this is really where the kind of cutting edge in the fight against financial crime exists. we're moving beyond sort of these narrow scope of data elements to start looking at behavioral profiles and patterns of activity and connections across organizations that can help us tease out what is truly suspicious from all of the sort of normal activity that may just look a little bit unusual. One of the most powerful tools that's really been brought to bear in recent years is the addition of behavioral biometrics and signals. In my prior company, and then in companies like the biggest fintechs in the world, they use a lot of behavioral data to augment the core transaction information, and they've had some pretty remarkable results. In my prior company, we were able to reduce our false positives by over 90%, and that wasn't by reducing the overall volume of suspicious activity reports we were producing. I briefed a Secret Service conference at one point and was presenting after someone from FinCEN who had some aggregate statistics for the crypto industry up at the time. And I noted that we were filing over 60% of the SARs in the crypto space. So we were detecting a lot of activity, but it was very narrowly targeted at actual bad information, which drew a lot of attention from the law enforcement community. And we ended up being called upon to train a number of organizations accordingly. So
Matt, I'm going to ask you to wrap up shortly.
Okay. I think leading into the challenges, which we can get into this a little bit more, it's the only way we can really enable this at scale is if we start breaking down data silos and enable privacy safe learning and information sharing across the industry. And we can get into that a little bit in the next segment.
That would be great. Probably some people in the audience are aware of the UN statistics on financial crime that suggests that we're completely failing, $2 trillion plus in annual financial crime, and we catch less than 1% of it with the tools we have today. So it's an urgent need. Melissa, let me turn to you. As you noted, you're doing cutting edge research, focusing especially on AI in credit underwriting and working on the theory that there may be an opportunity to make lending much more inclusive and still highly predictive, if not even more predictive, with some new tools and data. Talk to us about what you see the potential upside of AI in credit underwriting.
Sure. And before I talk about the context of credit underwriting, I just want to come back because Matt and I and all of us have known each other a long time and have been looking at these issues. FinReg Lab, although we're a non-advocacy organization, if we have one true north, or if you will, one bias in the work we do, it is really trying to understand how data and technology can be used for driving greater financial inclusion. And part of that is appreciating something that Matt has put his finger on, which is more nuanced understanding, both with the data that can be used, but also the analytical tools that are applied to that data. Not only mean that we may get much better at identifying and pulling out the bad guys in our financial system for BSA and AML obligations, but it also has enormous potential inclusion benefits that, yes, should be studied, but that's relevant in the broader global context of, the almost 2 billion people across the globe who are considered financially excluded. And so getting better at are you who you say you are also means we're potentially able to let more people into our financial system. So just to underscore that point in light of Matt's comments. We at FinReg Lab engaged policymakers and regulators in particular roughly about 1.5 years ago, after we had done research really honing in on evaluating the potential inclusion implications of bringing non-traditional financial data, and what we mean there are cash flow data or transaction information into credit underwriting decisions. We wanted to look at both data and the implications of data and the implications of these more complex analytics, machine learning algorithms, to evaluate their potential both benefits and some of the major considerations as it relates to consumer protection obligations, model stability, and prudential expectations of the financial system. So we started by looking at the data. We really wanted to pull that aside and isolate the potential inclusion benefits. And it's worth calling out because Joanne actually said this at the start as well. So much of the value of these more complex math approaches to evaluating data really come from being able to bring in more information into those analytics. And so we isolated the data. I guess I should point out at the start, we have as many as 60 million US adults in this country who aren't able to be sufficiently credit risk assessed by using traditional bureau data or scores or metrics. They may have insufficient credit history, they may have no credit history at all. But nevertheless, we have much more coverage in terms of the broader US population's use of bank accounts. And I would also add in prepaid card accounts, and increasingly the use of mobile devices and the account transaction data that can be derived from those types of products through the mobile device. And so the question in front of regulators, and frankly all of us, is, are those data predictive? Are they inclusive? Do we really see that you can prudently credit risk assess populations with that type of transaction or cash flow data? And very importantly, do they create a potential disparate impact risk, meaning a difference between protected and non-protected populations? And so the analysis that we did back in 2018 found that the data are predictive, that of the lenders who we evaluated their use of cash flow, they were extending credit to populations who would traditionally have been turned down, including people who had no FICO score or Vantage score at all. And we found that the data were independently predicting risk. And so we've got lots written about that, including the legal and some of the core pressing questions around consumer permission data that you would be welcome to take a look at. So we asked the question about the data. Now the research we're doing is specifically looking at what about these analytical tools that are in some cases much more complex and potentially even opaque in terms of understanding how they work. And the question that I think we're all grappling with as a first order question is, well, can we sufficiently understand how those more complex machine learning models derive the outcomes that they derive? And so we are, as I said last week to our annual board meeting, we are up to our eyeballs in evaluating this question. What we're doing now is we have 7 companies who offer explainability techniques for lenders who would use simple to complex machine learning algorithms in their underwriting. Because again, the core question for all of us, can we understand how the models derive their outcomes? And ultimately, can we understand it for the purposes of doing this type of fairness assessment, communicating to the consumer about why a decision was made, and even just having certainty around, are the models stable and also robust as data may change underneath them? So,
Melissa,
yes.
This is great. I'm going to ask you to finish up this point, and then we'll come back to more of it.
Yes, Joanne warned us we would all take way too long. We are quite enthusiastic about the potential inclusion benefits, but there are significant considerations that I think we're all here to talk more about in terms of how do we get the rules right, ultimately, for the benefits to be derived from these types of more complex techniques and the alternative data that are being plugged into these underwriting models. So I'll stop there and happy to pick it up further when we keep going.
Perfect. We have just over 10 minutes left, about 12 minutes left. So knowing that you all can change on the fly, what I want to do is, I was planning to ask you to talk about the downsides and then advice. Why don't we combine those? Why don't we turn to you, Andrew? Talk about how you see the downside risks in all of these changes that we're talking about, and then talk a bit about advice for policymakers like those in the audience on how to make sure that we get this right.
Happily, I will try to make all those points very quickly. So I think, to be blunt, for the downside risks, the biggest risk is that the future will look like the past. So what AI does is it takes data about the past, derives patterns in it, and then makes predictions based on those patterns that we then use to inform decisions in the future. And so the biggest danger that the widespread adoption of these technologies can bring is this kind of unreflexive perpetuation of things about the past into the future that we don't like. And so when we're using these tools, the really key question, and I would say the key measure of risk, is how much of the past do we want to replicate? And so when it comes to things like financial inclusion and bias, that's a very, very, very big risk. When it comes to things like this is outside of the financial services context, but like medical diagnostics, it might be a little bit different. So the biggest risk factor is just what implicit bias, what implicit patterns are hidden in the data that the AI is going to pick up on directly or indirectly, as many AI systems do. So that's I would say the biggest risk for this group. There are many more, and I'm happy to talk about them in the future with any folks who are thinking about this from the policy perspective. In terms of what you actually do about it, and what I would recommend from a legislative standpoint, I would make really kind of 3 points. The first is that, as Joanne said, AI is not new. It's been around for a very long time. Because of that, we do not have to start from scratch. There are a host of existing regulatory and legal frameworks that can be applied. I would just point folks to model risk management frameworks, which is an area that's exclusively applied to the financial system. I think it's one of the most mature areas of regulating and managing algorithmic risk. And so I would encourage folks on the Hill to get familiar with that before thinking about what new legislation or additional legislation might look like. I would also emphasize the importance of risk assessments. The Algorithmic Accountability Act is big on it. Basically, I would say in my view, every major, serious, and practical new take on the regulation of AI is very heavy on what a risk assessment looks like. They're kind of adopted from privacy impact assessments from the privacy space, but I think that's something to pay very, very careful attention to. And then last, I would just say incentivizing bias testing, understanding how to do bias testing, understanding what protected attributes in the data even exist is a major, major impediment to existing ways that organizations test for bias today. And I would just say, to make that even more explicit, lots of organizations don't want to know racial or data pertaining to sex or gender because it's a liability, and so they will collect data and explicitly leave those fields blank. And they do that because, one, they're under the belief that it's a little bit more legally risky to collect that data. And so I would just say, helping those organizations get that data, ask their consumers for racial and sex and gender information, and then incentivizing them to actually use that information to engage in bias testing is really, really, really critical. The FTC commissioner just published a white paper a few months ago that I was one of the editors for, focused on algorithmic harms, and she explicitly has a section on that. It was published by the Yale Information Society Project for folks who want to look it up. So anyway, those are the 3 points. I'll leave it at that. And thank you for the great question.
Great, thank you. If we have any time, we might be able to take some questions from the audience. If you want to put something in chat, we'll see how we're doing on the timing. Matt, let's go to you. Talk about downside risk and advice to policymakers.
The biggest downside potential risk I would highlight is not so much in the application of the AI, but in the failure to achieve its possible potential. In the financial crime space, we have a sort of status quo that there are a lot of siloed vendors that don't talk to each other. And as you noted, the result is that collectively, as governments and financial industry, we're spending hundreds of billions of dollars annually to achieve a less than 1% success rate. I heard yesterday from someone at the SEC that they estimate that there's $90 trillion in money that is attached to non-identified individuals in the United States that don't have any KYC on them, assets under management. So huge amount of information out there. And I mean, that inverse, financial institutions tend to be averaging more than a 90% false positive rate on things that they're alerting on, which means that innocent consumers are being caught up in dragnets because the tools are too old. So what we really need to do going into the future is build a new foundation that's really optimized for effectiveness. And there's a big risk that this may sound odd coming from a company that's building tools in this space. We need to be very careful about ensuring that we don't create a new set of walled gardens where each of these vendors just is doing its own thing and selling them value that they're offering based off of all the network value of all the other companies that who are giving them their data. We really need to, and I would encourage policymakers to consider focusing on sort of foundational level data standards that can, in some areas, enable organizations to learn from each other. This could apply in multiple consumer protection areas as well, like things like bias checks and such. If we have foundational protocols that we can build on top of that vendors can then enhance or financial institutions can work with directly, it can help us leap past this phenomenon that we have today of just no direction. There's basically, it's not even herding cats at this stage. It's just a whole bunch of cats running all over the place doing their own thing. And I think that's an opportunity for Congress to help set some direction.
Do you want to take just a second to talk about the potential of privacy enhancing technologies very briefly?
The 15-second version of it, and Andrew is a much deeper expert than I am, but just new AI and algorithmic and encryption techniques that can enable data, learning from data to happen without the underlying elements within the data being exposed to the recipients who are learning from it. There's a lot of very exciting stuff going on there.
And there are regulators throughout the world working on this, including in particular, maybe the Financial Conduct Authority in the UK, and FinCEN obviously very involved as well. Melissa, let me go to you to talk about downside risk and your advice and touching on the explainability issue. And we do have a question in the chat. Has Melissa's drive to make AI transparent investigated augmented intelligence in addition to the explainable AI issue? You might want to tie that in.
Sure, yeah, and I know we're running short on time. No, we haven't, but Deepak, definitely reach out to me. I'd love to talk about it. To your question, a couple things that I want to make sure we leave you all with. One is reach out to all of us as you are seeking to learn more. We are all going to have to get smarter about how these technologies work in order to understand how we are going to evolve policy and law in light of it. It's a different creature. Industry itself, back to Andrew's point, I think is going to be grappling with questions of how do we self-assess without feeling like we're running the risk of getting ourselves in trouble. I think there have been some developments in the BSA AML space where there's recognition that as industry starts to use more sophisticated analytics, it may find things that it didn't know about in the past. I think that's something policymakers would be beneficial for them to pay attention to. I think separating out sort of headlines around concerns around, black box, bias risks, et cetera. And I'm not saying that there aren't those risks in machine learning and credit underwriting. There definitely are. And I think differences in supervision have real implications on that front. But nevertheless, I do think the fact that we have really explicit laws, whether industry is necessarily following them or not, but that do require this evaluation for fairness purposes and a disparate impact assessment, at least gives us something to hang on in terms of having expectations of industry to do this kind of fairness evaluation. At the same time, part of what we are looking at is understanding where the limitations are in terms of existing law for evaluating for fairness, because right now we have an explicit prohibition of using protected class data or proxies for protected class data. If the models themselves are so complex and are finding those relationships, are we in the end really able to sort of approach this solely with existing ways that we undertake the disparate impact evaluation? There are academics who are asking big questions of perhaps maybe we should be thinking about allowing the use of protected class information in order to make sure that we understand how the models are working. And also with that additional data, we will get better insights perhaps, and we may actually be able to drive greater financial inclusion. And so there are big open questions, societal and policy questions we're going to have to be grappling with.
Thank you so much.
Sure.
We are wrapping up now. I think we are out of time, and I believe there's a plan to make the contact information of all the speakers today available, and I know everyone would be happy to follow up one-on-one. And also, I believe there will be available a recording of the panel if your colleagues or you want to look at it again. but I would love everyone to join me in thanking the panel. If we were together, we could give them applause. And now I want to hand off to Minerva Tantoko, who is going to lead the next panel. So Minerva.
Hi, everyone. Thanks for joining. I'm Minerva Tantoko. I have a longtime AI practitioner for over 35 years. And our next panel is an esteemed group of industry folks to talk, to drill down more on industry's trends and developments. I was also the first CTO of New York City for 2 years. I've spent almost 20 years in financial services and most recently co-founded a challenger digital commercial bank, and currently working on a book on ethical AI and consulting to fintechs and banks. So I'd like to introduce our panelists, Sundip Nayak, Chief Strategy and AI Officer for Linear Financial Technologies, Deepak Dubey, Founder and CEO of EazyML, and Kareem Saleh, Founder and CEO of Fairplay.ai. And I thought we'll just do a quick round of introductions. Tell us a little bit about your company and some initial thoughts. Sandeep, we'll start with you.
Yeah, thanks, Minerva. So I'm Sandeep, working for Linear Financial Technologies. I'm their Chief Strategy and AI Officer. Linear is the market leader in business lending infrastructure. And what we do is we provide modern digital infrastructure for small business divisions of the banks and non-banks to take the modern stack to in giving services to the small business consumers of the banks.
Great. And Deepak?
Thanks, Minerva. Here, Chicago, joined Bell Labs Research, long time. Eventually, went on.
Deepak, your audio is cutting in and out. Can you speak a little closer to your mic? Apologies.
Speak on myself. Is that better?
Yes.
Okay, cool. And then eventually co-founded IPsoft and now at DataNomers/EasyML as the CEO for AIML. The focus is on transparent AIML at DataNomers. Thanks.
Great. Thank you so much, Deepak. Kareem.
Yeah. Hi, everyone. My name is Kareem Saleh. I am the founder and CEO of Fairplay. We call ourselves the world's first fairness as a service company. Our tools allow anybody using an algorithm to make a high stakes decision about someone's life to answer 5 key questions. Is our algorithm fair? If not, why not? Could it be fairer? What's the economic impact to our business of being fairer? And finally, did we give our declines, the folks we rejected, a second look to see if they might resemble good applicants on dimensions that the primary decisioning algorithm didn't heavily take into account? Minerva, if you think it's appropriate now, I could set the stage maybe by just providing a little context on kind of the scope of the size of the problem we're trying to solve here. So
Yeah, absolutely. That's a great segue to our topic for all three, which is, how can we assure that AI is fair? And Kareem, please do share your maps.
Yeah, so folks on the call, I hope you can all see a map of the United States. Can somebody give me some verbal feedback that the map does appear? Yeah, great. So what we're looking at here, as many of you I'm sure know, the Home Mortgage Disclosure Act requires lenders to submit certain loan level data about their lending practices to the government every year. The regulators make that data available, but mostly in the form of spreadsheets, which are kind of hard to parse. So what we did was we scraped all of the data in the HMDA database for 2020, 2019, and 2018, and plotted it on a map all the way down to the census tract level to try to understand the state of fairness in the mortgage market for various historically disadvantaged groups. So what you're looking at here is the state of mortgage fairness to women in America last year. By the way, we're defining fairness the same way that many examiners and regulators do in terms of the adverse impact ratio. That is a measure of demographic parity. It asks whether one group experiences positive outcomes at dramatically different rates than another group. So, for example, if women are approved at least 90% the rate of men, you see the color green. If women are approved at between 80 to 90% the rate of men, you see the color yellow. And if women are approved at a rate of less than 80% relative to men, you see the color red. I was showing this map to an industry insider the other day who said, hey, look, there's a lot of green here. And I said, yeah, but there's a lot of red too, especially in the South and the Great Plains. And if you want to see what the map looks like for our Black brothers and sisters, let me show you. So this is the state of mortgage fairness for Black Americans last year in 2020. As you can see, in many parts of the American mortgage market, Blacks are approved at a rate of less than 80% relative to whites. These decisions used to be made by humans. They are now being made by algorithms, and those algorithms appear to be replicating the unfairness of the past. Anyway, thanks for the opportunity. Happy to join this distinguished panel today and talk more about these issues.
Thanks, Kareem. It's a pretty stark visualization of what a map of disparate impact or adverse impact might look like. So I'll take it now to Sandeep. What are your thoughts on fairness in AI, and particularly in banking and financial services?
Yeah, thanks, Minerva. So we have been, we do believe by applying responsible AI to banking, the products can be much more inclusive. And in fact, we have some data points where we have enhanced the spectrum of small business owners we serve by applying AI through linear to the bank population, where banks could not serve them with their products, right? But I think my view of fairness in AI has to be broken down into 4 different components, right? We mainly talk about the outcome. I call it the outcome fairness, which is whether the result of the AI system is inclusive or being fair to some certain constituent. But there are 3 other things. I call it data fairness. What that means is the underlying data representative of the population you're serving, right? There has to be specific public policy guidance on data fairness, right? The second one is design fairness. What that means is when a company or a group is designing an AI system to enhance the performance, what features, what variables, right? What kind of algorithms, and how you're setting up the AI system. There has to be guidance and a deliberate construct to design that, which I call design fairness. And the last part of the list is implementation fairness, which is when everything is ready, when you're implementing, it has to be implemented in a responsible way where there is no bias and have an auditability feature to that, right? So, so data fairness, design fairness, outcome fairness, which you're aware of, and implementation fairness. I think once we have more deliberate, structured approach to the overall fairness concept, right? I think we'll see a much better outcome to the maps what Kareem was showing, in my view, in the future.
Thank you. That's an excellent point. If you think about AI as the engine, then data is the fuel for that engine. And so the engine is only going to run as well as the fuel you put in. Now, Deepak, you mentioned transparency and explainability. So I'd love to hear your point of view on fairness from that perspective.
Yeah, I mean, Sandeep made an excellent point. He categorized fairness. So let's look at it a little closer. I know Andrew talked about model fairness. What do banks do, right? And so they usually do an exhaustive effort of validation. Hey, we must not do data fairness point that Sandeep made. Hey, we must not include gender, race, ethnicity. So they're doing that. So the question is, why is Kareem's map showing all those things? And I think the answer lies in how AI is being put to use here. So for instance, you remove all these factors, and that's okay. So now you're relying, let's say, on factor like FICO. But what is to say that FICO is not very strongly correlated to one of these things that we are trying to avoid? And is it a bad thing that so if it's correlated, it's correlated. After all, FICO is a measure of your financial well-being and ability to repay. But here's the critical challenge that I think many in the industry are missing, including some of the large financial institutions. So what is that? When you look at data, if the data is incomplete, then certainly some of the factors that are there will have outsized representation and influence in the outcome. And that is why Kareem's graph reflects what it reflects. Some of these factors have an outsized representation on the outcome of whether to lend or not, and they are correlated to some of these other factors that we're trying to avoid. What if we used tools in transparent machine learning, to the point you asked, Minerva, to find out if the data itself, where it all begins, is complete to begin with, before we undertake this massive exercise of developing models, productionizing them, validating them? Is your data complete to begin with? Are you sure you have included all the parameters that should be included to determine whether or not credit facility should be extended? That essential question, I think, is not answered comprehensively today. That is why you see Kareem reflect the biases that we are trying to avoid, in spite of the industry practicing AI/ML.
Yeah,
my 2 cents.
That's really great. And Kareem, I think you might have some thoughts on perhaps some methodologies or techniques that that could help combat some of the baked-in bias, whether they're in FICO scores or other or incomplete data sources. So I thought maybe you could talk to that before looping back to our other questions.
Yeah, sure. Well, so I appreciate Sandeep and Deepak's comments very much, and I want to associate myself with them. I think, on the one, and something Sandeep said actually gets to the foundation of why we started our company, which is, how is it on the one hand that we have these seemingly robust anti-discrimination laws, and on the other hand, bias in lending appears to be ubiquitous, if you believe these maps. And I think that, and the answer to that is complicated, but here are a few factors that might have gotten us to this point. One is that our system of evaluating models for bias has focused mostly on inputs. And so what we've done is we've said, hey, if we just look at all of these variables individually and they appear not to be facially or obviously discriminatory, then we should just put them into the model. And they should be, fair. But of course, what we see is that we still have the same home ownership rate among Black Americans that we had at the time of the passage of the Fair Housing Act. So this attempt that we have made over the last 3, 4, 5 decades to achieve fairness through blindness, I think hasn't worked. And so I think there's a question about whether or not we should be trying fairness through awareness. And this gets to a question that Melissa raised earlier, which is, should we be using some of these protected attributes, at least during model development, to make sure that these models are sensitive to populations that are not well represented in the data sets? The other thing that I'll mention is, the law is written in a slightly funny way, because it says, you're not allowed to discriminate unless the discrimination is related to a reasonable business necessity and there is no alternative, less discriminatory alternative means of achieving that business necessity. But what's happened is that third leg of the stool, searching for less discriminatory alternatives, has largely been ignored. And so I think that one of the things that we need to do is move given the natural tendency of these algorithms towards bias, is that part of the model validation process needs to include a much more rigorous search for what are called less discriminatory alternatives. Can these models be tuned or adjusted in other ways to mitigate their natural tendency towards bias? And by the way, we don't have to look very far afield to see that this is possible. Let me give you one example from the world of self-driving cars. If you think about the way Tesla programs its self-driving cars, it uses neural networks, and all of these algorithms must have some objective. And so if Tesla gave its self-driving cars the objective of simply getting you from point A to point B, the self-driving car might do that while running through red lights, or driving the wrong way down a one-way street, or running over pedestrians. So Tesla has to constrain the objective that's given to its self-driving car. It says, get the passenger from point A to point B while also obeying the rules of the road. And we can impose similar constraints on the algorithms that are used in financial services. Predict default accurately while also minimizing disparities between groups. So I think that we probably need to be headed for a conversation about the ways in which AI can be harnessed and tuned to ensure that it doesn't tend towards its natural state, which is bias against populations who are not well represented in the data.
Thanks, Kareem. I think I'm going to combine the next two questions for Sandeep and Deepak also, because it is around this notion of, okay, we can use AI and ML to detect bias. We could potentially even use it to reverse detected bias. And how can Congress be helpful in promoting that level of innovation? And what are some of the impacts that you see, whether it's for small business and propelling the economy forward? Sandeep, do you want to jump in on that?
Yeah, so I can take that. Yeah. So one thing which we all agree is the benefits of AI. The benefits of AI in approving more small business owners. The benefit of AI in driving better experience for the consumers, right? Benefit of AI for the banks and other financial services and other companies, right? We also talk about fairness and other regulatory means, which are old, which needs to be updated to match the evolving AI systems, right? I think what needs to happen as a guiding principle is putting adoption at the forefront of while doing smarter regulations behind, right? What banks, because I work with chief execs of banks day in, day out, being the platform provider for the banks. I can tell you there is a lot of smarts, lots of capabilities and systems ready to adopt AI. And why I say banks, because in financial services, banks is the biggest conduit by which the products can reach mass spectrum, right? So that needs to be unleashed through banks. Now, what is happening is the adoption is slow, though I do believe it is reaching an inflection point in next many years. What can expedite that is a good signaling from public policy signaling from regulatory organizations and from the public sphere towards the bank on how to adopt, how to use AI in a more specific manner. Like one example was what just Kareem said, where using that third leg of the model risk management to be more specified, right? I think, and sending a clear signal that adopting AI will have broader benefits, acknowledging that fairness issues cannot be eliminated, but can be definitely reduced and go in the right direction, right? When I talked about design fairness, data fairness, our implementation fairness, having specific symbolic points memorialized in documents and sending it to banks, and knowing that transparency is an issue of the past, in my view, there are sufficient technologies which can shed light into transparency and explainability, right? Encouraging that, spreading that awareness across the media, across public, and I think that can be a great start in turbocharging adoption of AI among other mainstream players.
Thanks, Sandeep. I think you're absolutely right. It's incredibly valuable for practitioners and regulators to work together. Something that the group that I'm part of with Joanne is the Alliance for Innovative Regulation, and there's such value in having that crosstalk there. And Deepak, since we've been talking about transparency a lot, what are your thoughts on this topic? How can Congress be helpful here?
Sure. You know, one of the biggest hurdles for financial inclusiveness, and Melissa talked about it, is that the people left out of the financial mainstream are thin file candidates. They do not have the financial history to, it's the chicken and the egg story. If you don't have the financial history to be included in credit decisions, then you are left with the loan shark. But there are other alternate data that we could use to supplement the lack or paucity of financials so as to build the case and selectively make sound financial decisions for the thin file candidates that otherwise would have been excluded. So it goes back to completeness of data. And so you have a lot of alternate data sources, right? Melissa talked about prepaid and mobile payment services. We at Data Nomers talk about web data. Everyone's life history is documented on the internet. And what can that mean? So you get tons of these alternate data dumped on you. And the hope is, how can we glean through them to pick out those who we should lend to? Because banks want to lend to more. For all that's growth is a big part of their story. So how do they make sense out of a truckload of data that is being dumped on them to find out policies, rules, guidelines, to say, oh, if this is that and this is this, then we do this. How do we make it action? Again, transparent Minerva, transparent ML to the rescue, because things like augmented intelligence coupled as a priori mechanism and explainable AI as a post-priori mechanism provide precise answers to these kinds of questions as to which of these information elements are truly meaningful in a customized setting, because not one size fits all banks. You have a different risk appetite, policies, procedures, demographics you serve, and so constituents you serve. And so you can customize it based on the automation afforded by transparent.
No, that's great. I think, not to be too simplistic, you're not going to go into the underwriting engine and see there's a rule that says don't lend to women in these counties, right? That rule doesn't exist. And I think
it always finds its way indirectly through the back door, like Kareem's view graph showed.
Right.
And so the reason is, like we were all discussing, you have incomplete data. And so some of these variables get outsized influence. And when they go about, and then it's over-reliance and overfit on certain of this data that causes the biases to be.
That's right. Well, and you treat it like a bug in a program. Something went wrong. What caused it? What was the root cause of that? So I want to spend the last, maybe a little less than a minute each on some final thoughts. We started with our previous panel on the upside. I do think that there are some really great trends that are incredibly hopeful in AI, and particularly in regulatory tech, compliance, and others. So we'll go around again for some of your final thoughts. Kareem?
Yeah, thanks, Minerva. So I'll make a few points, just kind of rapid fire. The first is this one that we were touching on earlier, which is there are increasingly good AI fairness techniques which allow you to constrain these algorithms in a way that can enhance positive outcomes for historically disadvantaged groups. We need to see those techniques be used more in financial services. Second, we have the benefit of a good model risk management regime in financial services. The problem is that the risks are mostly defined as risks to the financial solvency of an institution or the safety and soundness of the financial system, it would be good if that guidance could be updated to include unfairness and bias as a form of model risk. It'd be great to get some guidance from the regulators on fairness definitions and thresholds. It'd also be great if we could insist on much more rigorous searches for less discriminatory alternative algorithms, which some of these new AI techniques permit. Finally, if a word to Congress on things that they might be able to do to promote innovation. It has been discussed for many years, but never seems to be achieved, is an open API for income verification at the IRS that can assist in the kind of cash flow underwriting that Melissa Coity's group has done at FinReg Lab. And again, a focus on trying to achieve fairness through review of the outputs, not merely the inputs, because we know that a review of the inputs, fairness through blindness, has not been enough to remediate some of the unfairness that we see, for example, in the mortgage market, which no doubt exists in other consumer credit products as well.
Absolutely. And some of those alternative approaches actually have been shown to lower default rates, right? So Sandeep.
Yeah. So I think in the last 7 years, primarily through technology and fintech organizations, the various use cases of AI has been proven. There is a lot of value which has been unleashed, especially by increasing the approval rates across the consumer base, giving a better experience and reducing the cost of delivering credit products. Now, the question is, how do we scale the benefits proven by the tech and fintechs across the world? I think there the precursor is spreading the awareness through collaborative effort between government, private, fintechs, and of the latest and greatest of explainability's fairness concepts, which has been out there, and knowing the fact that regulatory bodies need to give more detailed, symbolic, and prescriptive guidelines to the banks, which has the ability to adopt and unleash the benefits of AI in a responsible fashion, right? Mm-hmm. And a subtext of that category of thought is a couple of areas which I call low-hanging fruits is fraud and building APIs to the government data, right? Which can go a long way in improving our delivery systems, whether delivery of credit, delivery of government money, delivery of XYZ. Fraudulent, like as we all learned from the past PPP experience, that when we read all the mainstream media papers, other stakeholders, there was a substantial amount of fraud in the PPP programs, right? I think encouraging use of AI-based systems can definitely reduce a lot of waste and fraud. That's one example of a government program which can be applied to other programs, number one. Number two is government itself is sitting us off a lot of data, which can...
I'm gonna ask you to wrap up so we can move to Deepak and then Svetlana
Sure.
will wrap up. Yeah.
A lot of data which can help democratize adoption of AI across the board. In the end, I think there is a responsible way of adopting at scale, and I think we all should work towards that.
Great, thank you. Deepak, and then Svetlana will wrap us up.
Really quick, we're talking about fairness and a lot of financial fairness, but financial fairness will stem from educational fairness, because that's where you get your opportunities in life. So we'd be amiss if we went without talking about STEM education and the role Congress can play there. Because internet leveled the playing field for access to information. AI/ML, believe me, you are at that unique moment in the history where AI/ML has the potential to level the playing field for access to intelligence. So you can have these no-code AI platforms that the less privileged kids can use in the US and eventually the world to invent smart apps, intelligent apps that will then catapult them into financial means.
So Deepak, thank you.
Thank you.
Closing on that was absolutely brilliant, because you need the diversity not only in the data and the AI, but in the people that make the AI. And so, STEM education is absolutely key. Thank you so much to the panel, and Svetlana, up to you.
Great, thanks so much. No, we really appreciate this informative conversation today, and thank you so much for sharing your insight and also the recommendations that you have to the staffers that are on here that are working on these issues for their bosses. I think that the intersection of the financial services space and AI is really interesting and clearly a growing field. So really appreciate you guys taking the time, and looking forward to continuing this conversation. And if we can ever be a resource, please let us know.
And please, reach out to any of the speakers today for any follow-up questions.
Thank you, guys.